ground rules straight. If you've got a question in your mind, it's guaranteed to be the same question in at least one other person's mind here today. Okay? So feel free to interrupt and we'll work our way through. What is this brave new world of these revenue standards? This is in defence of the Australian Accounting Standards Board. You might say, why in hell are we doing all of these changes? And the reason is there's an important social policy benefit from adopting the changes. That's why this is about. We'll talk today about the impact of these standards and how they're to your benefit and what pains and agonies they'll also cause you as you try and think about it. Okay? Firstly, do these standards apply to you, to your organisation or organisations you're attached to? There's a common misconception amongst some NFPs that they can pick and choose which standards they want to apply because they're producing special purpose financial reports. And many organisations produce those. General purpose, you state that you're complying with all of the standards. But for not-for-profits, I'm going to use two words, true and fair. Both of these words are used in the Associations and Corporations Act and in the Australian Charities Not-for-Profit Commission Act. To be true and fair means you comply at very least with the measurement and recognition principles of the standards. So it means you have to think about the transaction that you're considering and how the standards apply. And that's difficult. And sometimes you require advice. That's what we hear as auditors for and accountants as well. So it's highly likely these revenue standards will apply. And many people are unprepared for that. As we've been doing our audit planning meetings and our interim audits across the state, not many organisations have actually thought about how and when these standards will apply. They don't apply unless you early adopt them for 30 June this year, so people aren't thinking about FY20. This is all about primarily FY20. So AASB15, Revenue on Contracts with Customers, and 1058, Income for Not-for-Profits, are the two standards we're talking about today. They apply for not-for-profit entities for the financial year FY20. Now, if you've got a December year end, as Barbara does, you've got a 31 December year, sorry.
We use the financial year.
Financial year. It does apply to FY19. You can have early adoption if you so wish, but very few people are prepared enough to early adopt them for this financial year. When you adopt them, you have to restate this year. Right? People haven't quite got their head around what that means, but it means that in next year's financial statements, the prior year comparative will be different because of the application of these standards. Okay. Now that may have various implications for you. So let's have a look at AASB 15. It's a 5-step model and requires organisations to consider whether a contract exists. On your tables, you've got 2 example contracts which we'll be talking about today. One called Core Funding and the other one called a Careers Expo and Symposium. So it's important you've had an opportunity to have a look at some of those. We'll be trying to identify what parts of the contracts are relevant to determining which standard applies. The explicit and implicit promises in a contract. Recently I gave advice to one client on a situation in which the contract was not written. They were simply billing the agency they were connected with. Is there a contract? Is it implied? If there's a regular pattern of payments, it's highly likely there's an implied contract. Then you've got to figure out, why are they paying me? It's a good question, isn't it? You keep sending them invoices and they keep paying you, but on what basis would they say, no, I will not pay that? So sometimes a contract is implied and you've got to figure out what the terms are of that particular contract. we'll talk about a transaction price. Now, anyone like poetry? Hands up if you like poetry. Okay, well, I love poetry, and one of my favourite poets is T.S. Eliot. His critic Ezra Pound used the term, "Words break and bend under the burden of meaning." He was trying to tell Eliot how to write his poetry, and Eliot didn't like it very much. But in this case, the words do break and bend. What are we talking about with transaction price? That means we have to think about the transaction and what's happening between the people. What gives us our entitlement to income? And then how we allocate that price over all of the performance obligations. Okay? Let me take you over to its impact on budgeting. At present, for those with 30 June year ends, you would have formed your budget for FY20, hopefully, or you're close to it. That's an overall agency budget. Then you've got cost centre budgets, for each grant or service agreement that you have. But below that, we're talking about a level 3 budget for particular service obligations for each cost centre. This is new territory. What's a service obligation? How do we get from here to there? And you'll be talking about a markup. What's the markup for your organisation? If you've got a negative budget, you've got a negative markup. Right? If you're losing money, you're planning to do so in your budget. Right? The standard anticipates you looking at making some surplus. As we go around the state with our interim audits and audit planning meetings, we're looking at budgets going forward, and very few organisations are getting above 2% surpluses in their budget. We encourage 5%, but I haven't seen too many 5% surpluses for FY20. The reason is our wages are going up considerably. Let's move on. So there are 5 steps that you have to think about with recognising. Identifying the contract, identifying the performance obligations, determining the transaction price, allocating the transaction price, then recognising the revenue, and then I'm going to baffle you even more, recognising contract liabilities and contract assets. It's wonderful. These standards ask us to think. Thinking's good for you. It keeps you young and vitalised, and the old grey matter keeps renewing itself. But you'll be learning these new words and then applying them in your particular circumstances. And some of you might say, I'm sick of doing this because it's a change inevitably happens. But the social policy impact is that this is a better description of the transaction. That's the argument for it. It's been adopted internationally. So how do you apply 15 to a not-for-profit transaction? There are 2 critical elements that need to be satisfied. There's an agreement. You've got examples of such agreements that are written on your table. And there's a promise to transfer goods and services, more words, that are sufficiently specific. The short one, I'm going to be asking you to analyse those contracts on your desks to see whether the obligations are sufficiently specific. If it's not, then the other revenue standard applies, 1058. So if I were you, I'd be racking over all my contracts saying, surely these are unspecific performance obligations and I don't have to apply this revenue standard. Right? And the auditors will come in and say, no, we think they are sufficiently specific. And you'll say, oh damn. 1058, income for not-for-profits, has got something to say about it. You need to analyse the grants and service agreements, such as the 2 on your desk, into 2 groups, those which have enforceable rights, or more words, enforceable rights. You'll be looking at these agreements to see if you can find the little paragraph which establishes the enforceable right. and specific obligations. And there's a big underline and. If you fail on either of those, you default to 1058. So again, you'll be reading your contract saying, surely there's no enforceable right in this agreement. And mostly you'll be disappointed. Sometimes you won't. Those that do not have enforceable rights or specific obligations default to 1058. Okay. Have I baffled you already? With me? Okay. Enforceable rights, specific obligations. That's what you're going to be looking for. And they'll be the keys to determine which standard applies. So, what is sufficiently specific means? Now, your judgment will need to be applied here. In assessing whether a promise is sufficiently specific, you're going to take into account any conditions specified in the arrangement, whether explicit or implicit. Uh-oh. How do I know if it's implicit? Well, that becomes the practice of your arrangement. I keep sending these invoices, they keep paying us. There must be something specific because I'm billing them and they've given me money back. So there must be an implicit arrangement. Thinking about what that is becomes very important. The nature of the goods and services, the cost and value, the quantity and the period. If one of those is missing, it probably fails as being insufficiently specific. Here's an example of a not sufficiently specific. A not-for-profit entity may provide a number of services under its charter, such as counselling or housing to disadvantaged youth. When it receives funds to be used for an unspecified purpose over a particular time period, such a promise would not meet the sufficiently specific criteria. Here is money to deliver services to unemployed, disadvantaged youth. Is that specific? It's targeted, but it doesn't say what you've got to do. It doesn't specify the nature of the service. It doesn't specify particular outcomes that they're wanting to look for. And there's no evaluation process. So you're asked to analyse the contracts involved. If funding in the service agreement doesn't specify the period over which the entity has to use it, then it defaults to 1058. So you're combing those contract agreements to look, is there a particular period in which this relates to? If it's not, you default. Right, so we're going to look at these two examples now. The core funding agreement and the careers expo and symposium grant agreement. So I want you to discuss these in your small groups, but I'm going to ask you to look specifically at certain clauses. Now, this core funding agreement is typical for an increasingly smaller number of agencies. In this particular one, which has since been cancelled, I have to say, it was a contribution to the overall organisation, and they had to do specific certain things. In the contract, you'll have a close look at Schedule 1, and then a close look at Clause 4, and tell me what you think. Discuss it in your small group first. This is the core funding agreement. Anyone not got a core funding? Chris? All looking at the core funding agreement? financial, clause 4. Let's have a look at what people think about the core funding agreement. Has everyone found what the performance obligations are? Have you found what the performance obligations are?
It probably doesn't apply to us. I'm not sure. If I look at the right thing, the repayment of retention of grant funds, is that what we're looking at? That one, is that clause 4?
And that relates to enforceable rights. Right. So let's deal with enforceable rights first. Is clause 4 an enforceable right for the funder?
I'll say it is.
Okay. Yep, and I'd agree with that. Yeah. Anyone has a different view? This is where judgment's involved. What would you say if the funder never asks for money back?
Through its actions.
Yes. If you went back 5 years ago, that would often be the case, that the funder would not ask for money back. But things have changed, haven't they? If you haven't done it, we want it back. That's the current climate. Okay, let's go to the performance obligations. Have a closer look at clause 2 and clause 1 in the schedule. Clause 1, to provide core funding to XYZ. Clause 2, XYZ will deliver. Okay.
We thought they were quite vague, Bob.
Vague.
Not very specific.
Oh, well, the person who wrote the grant guidelines would be very disappointed to hear that.
I disappoint the government frequently.
Tell me why they're vague.
We didn't see there any real way of measuring a successful implementation of it.
Oh.
So, as an accountant, I want to measure stuff. And we can't see any way here of being able to measure the implementation of the grant.
But surely a policy position and an advocacy plan is something.
How long's a piece of string when it comes to policies?
Very good.
And the lives of all particular people in WA. Very wide range.
It is, isn't it? on that basis, we've got an enforceable right, but not sufficiently specific performance obligation. So here, we would say non-specific and AASB 1058. And you might well ask, why is he writing on the board? Because I've developed this question, what is a contract register? Okay. Who already have contract registers? The reason is, that's where the rubber hits the road here. That's where you list your all of your contracts, identify the specific performance obligations and the revenue recognition rules. And you'll see then a little note to a reference, another tab, which will define how you allocate the performance obligations across the transaction price. Okay. This is what auditors will be looking for in FY20, a contract register. If AASB 15 applies, we won't be looking for the core funding agreement as applying AASB 15. We'll agree with you that 1058 applies. Okay. Right. On to the Career Expo and Symposium. You now know how to read these agreements, so you'll go quickly to the schedule and clause 4, won't you? You know what auditors do when we get it? We love contracts. When we get them, we go through to see, one, can this money ever be paid back? We scour it for that particular clause and are delighted when we find it. This time I'm going to go table to table. I'm going to ask you to defend your classification.
We've done it. We're okay. We've already done it.
Appoint a spokesperson.
We've already done it.
Now, I have to give you a hint. There's a twist in this one. we go? Which table wants to go first? No pressure, Ashley.
Well, firstly, we think you have edited this grant agreement by putting particular capital letters as a sign in the second one to allude to the fact that it is specific and there are specific performance obligations in the employment symposium. The Career Expo, not so much, because it doesn't actually specifically define what they need to do. So there could be an argument that there's no specific performance obligation and specific, but definitely for the employment symposium there is.
Oh, so you say there's one part of the contract which is specific,
Potentially.
and the second part of the contract which may not be. Okay, well, that's an interesting point.
Potentially.
What does your table say, Eddie?
That's the first person who's been to me.
What would you like my opinion on, Bob?
Which standard would you apply and why?
I would never disagree with my business partner, Ash Dawson, on this ever. So I think, yes, I agree. Both.
Both.
One to each.
They also have implications for you, won't they? Because you'll be splitting up the contract between a specific performance obligation and a non-specific performance obligation.
How do you know how much money for which?
But surely, if I run the expo and I run the symposium, haven't I satisfied all the obligations? What do you say, Judy?
Well, I don't think so, because your reporting requirements ask for outcomes on those, what you've delivered.
Reporting requirements give a telltale sign. You've got to document your outcomes. They haven't told you which outcomes they're expecting now, have they? What do you say, Anthony?
Well, I suppose we were of the understanding that it was specific enough.
So, if you account to the funding body, you asked us to deliver an expo, you asked us to deliver a symposium, and we've done it. But was that all you had to do?
What if nobody came?
You have to provide evaluation report.
An evaluation report, yes. And if no one came, as Chris said,
You did a very good job.
you do a very good job. Has the funder required that those two events be of a particular level?
Yeah, I think they have.
What have they said?
I don't think they have.
Anyone find a reference to how they've specified the level of performance of those two obligations across the
Well,
board?
the career expo is quite specific. You've got age ranges and targets,
Mm.
whereas the one below is more general.
Correct. Okay. You've correctly identified the twist. I won't labour it any longer. But here we have a contract in which part of it you'll apply 1058, and then part of it you'll apply AASB15. So and that's why you'll have performance obligations at level 3, one of which will specify a transaction price for AASB15, the other one will just recognise the revenue when you receive it. See, that's going to muck up the accounts, isn't it? That is the telltale issue with AASB 1058. Most commonly, and there are some exceptions, it's revenue when you receive it, even if it is a multi-year intended fund. For example, if you get fund from a donor who intends you to run a project for 3 years, so it's a donation, but it's to run over 3 years. You'll have to have a question in your mind, are the requirements of that donor sufficiently specific to recognise it over the 3 years? If it's not, it's income when you get it. This was one of the big problems with the existing standard 1004. When you're budgeting, going back to budgets, you like money to come in over time, don't you? It's beautiful. You see it flowing in all the way along. And you can pay your costs as you go. You don't want a lump of income at that point in time. You want to spread it. That's the natural drive of accountants, that they've got to spread things out and match things. There's no matching here, there's no matching principle.
Even if you say incurred a cost, book the room. You know the symposium's coming up, we know we're going to get the money. I've paid a deposit on the Rendezvous Hotel to book this room, but I haven't had any revenue yet.
Yes, it's an expense because you're applying 1058 to the symposium,
But I haven't got any revenue.
you've got no money. So you break that matching principle. We hate it, don't we? It doesn't feel comfortable. But the reason is you haven't got a right to the income yet. Similarly, this causes you to think about your budgeting process and when you will apply these standards. You might have a separation between your management accounting, your budgeting process, and your end of year adjustments. It may mean that for budget purposes you don't recognise the income when it's earned, but alert your board to the fact you have already earned this. But for management purposes you're applying it over the period of your project. That's going to cause confusion. Right? So getting expectations right and explaining when you have earned it, here it is, we've got the whole money for this, it's not sufficiently specific, so it's our money, we've got a moral obligation. Interesting, morality comes into this. It's wonderful, isn't it? Accounting standards are exciting. We've got moral decisions being made here now. We've got the money, the requirements aren't sufficiently specific, yet is there an enforceable right here? Okay, they've got an enforceable right, so you need to inform the board, we've got the money, but we have to deliver on this. So we've got a communication issue here, haven't we? But you're going to recognise in your contract register how you're going to deal with the Career Expo and a separate one for the symposium. Grumble, grumble, grumble. Who wants to do it this way? But it's actually reflecting the reality of those transactions. It's not neat though, is it? The accountants love neat things. This isn't neat, so it's going to require a lot of you to explain this to the people who are understanding your financial statements. But here's a worked example. Okay. This is a developed one from the last one I showed people. A not-for-profit enters a service agreement with the Department of Communities to provide 5,000 service hours for certain clients for $300,000 at $60 per hour over 12 months, at on average 420 hours per month, and tailing off at 380 for the last month. Okay. This is a common type of service agreement where hours are what is being delivered. We're presenting a similar thing to a manufacturing client tomorrow where it's units being delivered. The same approach occurs. So here we've got to analyse whether this is sufficiently specific or not, and then see which standard we apply, and then go through the steps in the standard. So hold on to your seats. This gets really interesting. They've also got to provide a monthly progress report on hours delivered, remaining hours to be provided, and explanations for delays and issues. So there's a reporting process. And at the end, they've got to deliver a report saying that they've proven they've delivered it with quality. Okay. So, is there a contract? Yes. It's written. 3 promises. Now, are these specific performance obligation with enforceable rights. Well, it's pretty specific, isn't it? You're supposed to deliver 3,000 hours, 420 for the first 11 months. On average, 60 hours per week, monthly reports, annual quality assurance, and the contract, this is what the auditors look for first, that clause 4, indicating a right to reclaim funds if the services are not delivered. Which standard are we applying? 15 or 1058? 15, isn't it? Okay. You're getting the hang of this now because it's sufficiently specific, right? It's got to be, sufficiently means quite specific. So then we have to estimate the transaction price. This is a standalone or selling price. It's an estimate. Okay. You haven't delivered it, so you don't actually know what the final cost of doing things is and what the final price might be as you negotiate various delays and increases, etc. So it's an estimate. It's going to feed into your budget process all the way down, from the cost centre for this particular service agreement to the subsets for each performance obligation. Exciting, isn't it? Yes, I get excited about this. I was at Royce's organisation this morning, and the CEO got excited about actually knowing how much each performance obligation is going to cost them and how much they're going to make from satisfying each one.
That's because I've got to work it out.
She was excited. And I think as people get into this, they'll realise you really are honing in to what you're doing and finding out what it's costing you and how much you're making out of it, if anything at all. So there are 3 permitted estimation methods. The adjusted market assessment approach, the estimated cost plus margin, and the residual approach. You say, oh, more words. So, in our view, there's insufficient data to conclude that a market exists. Now, you might be operating with sufficient information from other organisations to know how much they are charging. You might say the NDIS is operating as a market because of agreed prices, but I can tell you there's a lot of variation between providers. That may allow you to prove that you can say, well, everyone is charging $60 an hour, so we're going to charge $60 an hour too. But proving a market exists is not very easy. So we don't think that'll be widely used, particularly when you're looking at the year ahead rather than the current year now. Similarly, a residual approach is only used when you've got the overall transaction price, but you can't figure out what the last one's worth. And the answer is it's the difference between what everyone else, what each specific service obligation costs and the transaction price, the residual approach. So you can use that to estimate your last remaining one because it's what's left over. But this one, the default one, will be the one that's most typically used, estimating a cost plus a margin. A margin? Markup. This is the most interesting but often the most difficult conversation I have with not-for-profits. Many still think, not-for-profit, we don't have a margin, we spend all that we get. And I say, you do that and you'll be broke within a very short time. Why do you have to make a markup? To manage financial risk and to plan for the future. Your markups are what provide you the money for capital works programs. The markups are what provide you the ability to pay interest on loans that you have and to manage growth. You've got to have a markup. In most budgets, as I said, that we're seeing now, it's getting hard to get a 2% surplus. Well, that might be your markup. In this sense, we're using markup in a slightly different way. It includes that overall surplus plus your ability to cover overheads. So, determining the transaction price. So in your budgets, you've done your big budget and your little budget, but then you've got to try and think through each particular cost centre program, how you split that across service obligations. So here, in this particular example, to deliver 3,000 service hours, the average labour cost, including on cost, is going to be $40 an hour, 120,000. Other direct costs, consumables primarily, in delivering that service, it's going to cost you 102,000. The accounting costs to provide the reports and the analysis of how the program's gone, going to cost you 6,000. The service supervision and quality assurance, you're going to need to get a consultant in to make sure it's all tied up, or you might have that internal resource, going to cost you 12,000. So your costs, you know, 240,000. And that's evident in your cost centre budget over here. Everyone's happy with that. Or the board's saying, wait a minute, you're delivering a $300,000 service. Are we really going to make $60,000 out of this? And the question is, what is your market? Because certain costs have been excluded here. They're called your overheads. So for each service, you're going to have to cover your overheads plus another margin. So your markup covers overhead and margin. So how do you do this? To determine the required markup to achieve your financial goals, your overall budget strategy says you're going to have a 25% markup to cover 7%. You could say 2, hope not, but you try for a 5, and 18% to cover your overhead costs. You might say, my overhead costs are more like 22%, right? Well, that means your margin is going to be 3%, doesn't it? So thinking about how you allocate your overheads will determine your price. So costs of 240,000 plus 25% is 300,000 that you're going to be billing. This is entirely at your discretion. You might say, on this particular program, it's a flagship program, we're not going to make anything. We're just going to cover our overheads. You might even say, on this particular program, that's so important to us, we're not even going to cover our overheads. Right? That'd be silly. I'm chair of one organisation which we've got 2 programs which are mission focused, they're core to what we do, and we subsidise those programs. In that case, you'll have a negative markup on that. And that'll determine your transaction price as well. So, this is where we get interesting. The budget, cost centre budget. Now your performance obligation budget, you're going to have to figure out how we're going to apply the income from these to each performance obligation. Here our cost, 120 and 102, 222,000. You apply your markup, 55,500, and your annual revenue from actually delivering the service is only 277,500, because you've got to deliver project reporting and service quality reporting. I've limited this to just 3, but you can imagine how complex it'll be as you go down the particular outcomes you're seeking to achieve. That balances to your 300,000. You charge this monthly at a transaction price of $55.50 per service hour. And you say, wait a minute, I contracted to deliver this at $60 an hour. That's your billing, not your revenue recognition. Poignant silence. This is a big ticket issue to understand. You might say, I've sent out, I've raised an invoice. That should go straight into my sales revenue, my fees, my service agreement revenue. But no, it doesn't. Right? What goes in there is the portion that belongs to the services that you've delivered. Okay, think about that. You haven't yet delivered these 2 services, but your price of $60 an hour contains those 2 services. contains those two services. So every bill you send out contains elements you've delivered and elements you haven't delivered. This is really getting you thinking, isn't it? So, the arrangement says you can bill your $60 an hour. Terrific. Inclusive of all service obligations. However, if you do so, you have to reserve the unearned and unperformed components as contract liabilities. For example, at the end of the month, you said you deliver 420 hours, but you only got to 400 hours. You're 20 hours short. So you're going to bill only 400 times 60, 240,000, 24,000. You only earn 400 times $55.50 or 22,200. I've sent out an invoice for 24,000. I've got to put this to somewhere. I'm going to put it to balance sheet, and then through a journal at the end of the month recognise the revenue across. Going to be a lot of journals going on. Auditors love journals. We go straight to the manual journals list and see what the hell's happened during the year. But we know that this is going to lead to a lot of journals going on. You haven't delivered the monthly financial report, which is $7,500 divided by 12, $625 you have not earned yet. You can't recognise as revenue because you haven't delivered the monthly report at the end of the month. It will come mid-next month. You have yet to make the annual quality assurance review, so you've got to reserve 1/12 of that, or 1,250, because you billed it. As a result, $1,875 is a contract liability at the end of the month. Okay, I think I get it now. I bill all of this out. I don't recognise it as revenue. It goes to my contract liability, and then I clear my contract liability for what I have actually earned to the revenue account. Okay. That means you've got to think at the end of the month. How much have we actually done that we're entitled to recognise the revenue for, even though we've billed it? Clear on that? What's the thinking going on? But there's a separation between your billing process and your revenue recognition process. That's what I want to get across. Okay. You've got to hold some money back if you haven't delivered your monthly and annual service obligations. So, but if you haven't delivered your service obligation, there's an upside. We have a thing called contract assets. Now, when the performance obligations are not yet met, the direct expenses are reclassified as a contract asset. Oh, does that mean if I haven't delivered my 20 hours, the costs associated with those 20 hours are assets? Yes. The answer is yes. But I've never done that before, and of course you haven't, because this is work in progress. That's probably the simplest way of describing it. Okay? But remember, Ezra Pound, work with words break and bend under the burden of meaning. The word direct is used. You can't claim your overheads. It must be your direct labour and your direct program costs. So these are capitalised until they're met. So if that 20 hours, you suddenly find that at the end of next month you're still 20 hours behind, it's still staying on your balance sheet as a contract asset. It's not a prepaid expense, but it's expenses incurred in expectation of earning revenue. In the hope of earning revenue. At the end of the year, if you haven't delivered it, remember clause 4 in the agreement says we want it back. So you won't be able to recognise that. Another interesting aspect of this is the cost to fulfil contracts can also be capitalised. Now, this means if you've engaged a consultant or you are able to capture the costs of putting in a grant or service application, a bid, and you're successful, you can capitalise that and put that into the expenses for the delivery of this program. Okay. A consultant may be used to prepare the detailed proposal costing $3,000. You get the award of the contract, so that becomes a capitalised cost against the revenue that you earn from that program. And then included in the transaction price. You might say it's $3,000, I think I'll just leave it as an expense. Right? But it might be $30,000 or $50,000 if it's a big project. So at the end of the month, you've delivered 400 service hours with 20 hours undelivered. The direct costs of 20 hours are going to be capitalised. The total direct costs are $222,000 divided by the 5,000 service hours, $4.44. 444. Just happened to work like that. By 20 means that I've got $1,776 worth of contract assets, right, which gets brought over when you've met those particular service obligations. Questions? Am I baffling you? Okay. The AASB has given you two hands. The hand that raises the bill, and then the hand that takes back the portion that you haven't yet delivered. Because the price embeds all of your service obligations. The bit you haven't delivered, but you've incurred direct costs in relationship to, it gives you the other hand. You can hold that back as an expense that is related to delivering a performance obligation as a contract asset. So revenue, expected revenue goes down, but also actual costs go down because they're shifted to balance sheet. Okay?
Where does GST sit on the undelivered?
Oh, that's a good point. We'll have to think about that.
If you're doing that, you're expressing it as an exclusive value.
If you're accounting on an accrual basis,
I don't know what accrual accounting is anymore.
if you're accounting for GST on an accrual basis, probably you'd be adjusting for these as well.
Yeah, take it out, put it in that the contract liability account.
Contract asset account.
So Bob, what are the implications where you just get grants and funds, so you're not invoicing?
Well, the grant in advance creates the same issue. You've got the money, but when can you recognise it? So it's sitting on your balance sheet, and you're only bringing it to income with the service hours you've delivered.
So you can, you don't need to worry so much about the billing. You don't need to worry about the billing aspect at all. It's really just the amount that you bring them to. Okay.
But it's interesting, if you're billing clients for services and you've made promises specific to them, so you run a group and participating in that group means at the end of it they're going to get a certificate. Right? If the cost of generating that certificate was substantial, you have to hold back the money to generate the certificate. Mostly a certificate you wouldn't worry about, but it has to be a substantial cost. So the disclosures in AASB15 are also, you've got to consider that as well. You don't have to disclose it contract by contract, you can disclose it by class of contracts. So long as you apply the same rules according to that class of contract. If you've got one large contract which is very different to all the other contracts you're into, you may have to be quite specific about how you've treated that particular contract. Okay. So, I'm going to move on to 1058. You say at last, my head's swimming with all of those figures going everywhere. The simple takeaway is that it's not yours until you've earned it. Right. So leave it alone. Leave it on balance sheet where it belongs until you can say, yes, it's mine. and then bring it in. Right, now 1058, this one tries to give, recognise the reality of the not-for-profit sector in which you receive some things at less than their fair value. For example, you acquire an asset, money, at less than its fair value. We haven't done anything, but this person donates money to you. So it's principally to enable you to extend your objectives. When this happens, you receive a cash grant to further your objectives without specific service obligation, so it's money when you get it. Right, you get it on the 3rd of June for the next financial year, it's still revenue on the 3rd of June. It's going to annoy you, isn't it? The donor gives you money on the 3rd of June for a project they would like you to spend on next year. Oh, natural tendency, isn't it? The desire that wells up within you is, no, don't make me recognise it on the 3rd of June. It must be recognised on the 1st of July. Don't you feel that? Yeah, it's wrong. You've got to suppress these unnatural desires that well up within inside you. It's income. If it's not specific, it's not enforceable, right? It's income when you get it. And the receipt of voluntary services. So I'll speak briefly about these particular areas. Again, the social policy advantage is to give the full extent of subsidy not-for-profits receive. Okay, and this is a tough slide, so really focus in on it. Okay. When a not-for-profit receives an asset for significantly less, Ezra Pound comes up again, significantly. What do we mean by significantly? Well, it's not defined in the standard. Now, you've got to exercise your judgment here. What's significant to you might not be significant to the next person. But it must be relevant to the size and financial impact on your organisation. That's the perspective as auditors will take. Okay. You might say it's not significant. Okay, then, okay, well, if it's not, then this won't apply. But if it is significant, significantly less than the fair value, you recognise the asset. So a person gives you a house, right, in a will. You're going to recognise that according to you're going to recognise probably a fair value. What's the market value of that particular house? And then you've got to figure out, what do I do with the other side of the entry? I debit house. What do I credit? This is the wonderful dilemma of accounting. Trying to figure out what side of the room do I put the transaction on, and where do I put it? Here it asks you to look at the what are called related amounts. Is it revenue? Is it a straight donation to us? Okay. Have we got to do something with this house? Right? Do we have a right to use it for particular purposes? And if we don't, we've got to give it back. So what does the contract say? What is the documentation? It may be a lease liability. There may be a loan arrangement in which you've got to pay the person a small amount for the right to use that asset. Or it might be a provision. In other words, it's yours whilst you keep using it for this purpose, and then it's not yours. So there may be contingent liabilities that you need, or contingent assets you need to consider. Okay, so this is technical, and you'll need to ask someone about it if someone gives you something. Get on the phone and say, what the hell do I do? Of course, it's more complicated. The difference between what these standards tell you to do and the fair value of what you've got is income, according to the standard. There might be a requirement to do something particular with the house, which you estimate is only going to cost you $100,000. The house has got a fair value of $500,000. Right? You're thinking about it, so there's $400,000 difference between what the liability has to be recognised as, and the fair value of the asset, the house that you've done. Whilst the board is jumping up and down with joy saying, we got a house, you're there saying, oh dear, I don't know what to do with the liability, and I don't know how to estimate the liability, but I can tell you that whatever's left over is income. And I'll say, oh, you're a killjoy, aren't you? So, thinking about it, you need advice when you get large assets that are applied to you, not simply a grant or a donation. Peppercorn leases, those who attended our seminar last year, the AASB has given relief on this. And these are leases that are significantly subsidised leases. Right? Not all leases are significantly subsidised, so you've got to attend our seminar on leases to know what to do with them. Okay, and they're complex. But there's the AASB's decided to give a temporary option to not-for-profits. Temporary option. So they haven't fully made up their mind. They're going to give some guidance on how to do this, which means that some of the boffins in the AASB still want this very much because they believe it's pure. Purity is what accountants at the technical level think about. We can't have impure transactions going through the accounts. That's a bit of a joke, isn't it? Most transactions are quite messy. So here they've given a temporary option. Right? You can still bring it to account if you so wish, but there's a temporary option not to do it. Okay? Now when you bring it to account in the current form of instruction on it, you've got to calculate the net present value of the right to use asset and its implications is quite complex. But you've got some temporary relief. Donations. Other words, a rebuttable presumption. Nothing like a presumption that you can rebut. That the total transaction price with customers related to the transfer of promised goods and services. So what that means is the money that you get, if it's not related to specific promised goods and services, then AASB doesn't 15 doesn't apply. And it's money when you get it. The presumption can be rebutted and the transaction price split into its component parts. What does that mean? Well, I'm going to give you an example. Fundraising. Now, here's an example of a concert series that you've negotiated a wonderful price on. Everyone's going to have fun and the organisation's going to get a wonderful donation attached to it, but it's also got to deliver some services to get there. So in this example, it was a subscriber gets a tax deduction for the above market value of the subscription to the concert series. You charged $300, the market value was $100, so the tax deduction is $200. But you've got a donation component, but you've also got the concert series component, which has got to be accounted for under AASB15. You've got to split the donation between what you've promised to do and what is the real donation component. Clear? Pain in the neck, isn't it?
Do they expect you to do this throughout the whole year, or just have a look at year end and go, yeah, these ones need to be adjusted at year end?
I think you've hit the practical way of approaching this. So long as you communicate to people the likely impact at year end, you won't do these adjustments until year end. But you need to have the mechanism to collect the information throughout the year for you to be able to make these adjustments. Otherwise you're in a horrible mess. But most organisations I talk to about this, they're intending to do it as year-end adjustment. But they're going to be quite big adjustments, and you need to communicate to your board along the way. This is the likely impact. Right? You might ask us as auditors or your accountants to give you a mid-year review to see what the likely impact would be at year-end if you did make all the adjustments. might have a particularly big transaction that comes through, and you say, well, at year end we're going to have to adjust it by, we expect to adjust it by this amount. But the numbers will be moving. Volunteer services, that's still available, it's still an option. For some people they intend to do it, for example, board member expenses. It may be that the market value of those board members is about $15,000 a year. Salary One, they do surveys on this if you want to get information relevant to your particular industry or particular type, subset. So for the board members, you've got 10 board members, you might say you debit their expenses, which are notional, $150,000, and credit board member donation, $150,000. Right. There's no impact on the bottom line, but it gives you the, it shows you the scales of community support to your organisation. I haven't got a lot of interest in people doing this, I have to say. But some organisations who have got big volunteer bases, I know, are considering it. Now, when you get money for constructing a non-financial asset, say you get money to construct a building, 1058 makes it clear that when you get the money, it goes straight to balance sheet, and you only recognise it as income as you gradually complete it. So it's you won't be able to recognise it. It's not income when you receive it, it's income when you graduate at each stage of completion. So at each month end you might decide we're bringing $10,000 across because we've done $10,000 worth of work. Okay? Now, here's an interesting bit. If you get a grant for a non-financial asset that isn't bricks and mortar, it might be to help you develop your intellectual property. Right? It might be the rights to your documentation on a particular course. Right? Judy, I'm thinking of courses that Linkwest had developed over the years. And there was an IP agreement, and the IP was owned by the organisation. However, it didn't meet the standards to recognise the asset. Right? And there wasn't any enforceable agreement, so it becomes income when you receive it. Now, if the other standards won't let you recognising it as an asset, but when you get the money, it's money that has to be recognised then. Now that's going to muck you up because you're getting the money and you've got a forward process of expenditure. Again, that matching principle is broken. So you really have to think about how you communicate this to the board and how the impact it is in your financial statements. One way of doing it is to expand your director's report and to identify the big ticket items that money you've received but you're expecting to do this in the future. You might include a note to the accounts which are your commitments. It's an expanded commitments note and let people know you've got this money, you've recognised it as income this year because there's no enforceable right or specific obligation, but this is your intention to do it. You may take up a reserve if it's a big item as well to reflect that commitment to those funds. So, how are we going? We're about 15 minutes early. Time for questions. Revenue 15, revenue on contracts with customers, focuses on your service obligation. So your budget, your cost centres, your performance obligations, that's an extra level of detail. You might say, well, we're not going to recognise it until year end, but you're going to need the work papers to figure out, well, what is left over, how much have we charged, how much are we entitled to, and we've got to put it back to balance sheet. AASB 1058 aims to better communicate the full extent of subsidy that you're getting, and this transparency enables donors and funders to better understand the level of community support that you're getting. And they're the best possible constructions I can give you on these two difficult standards.
Fine.